What's up, everybody? Happy Friday. Welcome back to another weekend prep edition for my notepad. I hope you had a good week, and it's going to get a little bit better as we close it out. A lot to talk about this week. Turns out uh, the world didn't end again, as about a month ago people would have insisted was going to happen. But once you've been doing this for a little while, you kind of develop a little bit of a resistance to that. One can sell the fear, but one definitely doesn't need to buy it. So I want to talk about some things. A lot of interesting news. Pattern day trader got removed this week. I don't know if it's a situation of just because you can doesn't mean you should. And then some updates on the software sector that have been happening. So we'll get into it in just a second while people filter in. Hang out for a minute. Listen to this non-DRM free music that I just want to play because I'm not monetized. All right. It was that time of year again this week when folks like myself who don't do withholdings have a big old tax burden. And I'm not going to spend any time on that, just to say that um, no, I'm not happy to do my social duty, not to that extent. Uh, Even if one would actually say it was, I don't get into politics at all, but I feel the need to speak my piece on this little tiny platform. That it's bemusing to me that as much money as we print, why do we even have to pay taxes? I know the answer. It's so that essentially you have a revenue stream of people, citizens that pay taxes, so that then we can back up the dollar, so it just isn't completely perceptibly worthless to our creditors. I get it. It just, oh, it hurts. It hurts. It hurts. But anyway, let's focus on making that money for the rest of the year. So the next year we can do it for the IRS. All right. So, well, this happened. Believe it or not, the world did not end, even though 2 weeks ago, if you had asked some of the experts, we were surely going to face imminent financial collapse worldwide and things would never recover again, which is exactly the same narrative that we had last year at this same time. What the high level view that I want you as traders, investors to take away is that the first quarter of every year is the time for you to really put your positions in. I wanted more of a pullback. I'm just going to be honest. The plays that I made this year were in contrarian fashion to go against the prevailing narrative. People have asked me like, well, why should I buy AI? Should I buy oil, energy stocks? The answer to that is not now. But in the pullback, and actually what I thought was interesting about this is, hey, Hey there, come here, come here. Oh, yes. Okay, okay. So this is my little dog, Indy. Yes, he heard me talking and he wanted to say hello. Say hello, Indy. Yes, yes. Can I do my live stream? Can I do my live stream? Okay, okay, okay. All right, yes. All right, go about your business. Okay, thank you. All right. Anyway, he wanted some love. So you guys have all heard Mr. Michael Burry, and I have a soft spot for him, not just because he's sort of a celebrity after The Big Short, but because I respect him as a contrarian. And people, because he has, that big win from The Big Short. By the way, if you haven't read the book or watched the movie and you like financial markets at all, it is at the top of anyone's top 5 list of like movies to entertain yourself with. That Margin Call is another one. Trading Places. Those would be, I'd say, my like top 3 most enjoyable like trading investing movies. Are there any others? Not those are just the 3 that come to mind. So he has been buying software companies because if you haven't been living under a rock, I don't know if you're watching this, you stay at least a little bit apprised of what the narratives are. This has been sort of the companies that are dying this year. And by the way, guys, if you have things to interject, I try to read the chat as fast as I can when I'm riffing. But yeah, make sure you get your symbols in. We'll look at them here in the last part, as we always do, including what is in line for this, which I'll spoil it, is my picks for this year were IBM and CrowdStrike. Every single year, you get some kind of a narrative about this company, it's really this sector. It's a meme. This sector is dying. In 2023, it was that banks were going to fail. 2021, it was that energy companies were going to fail. And we talked about this last week, and for the better part of this year, I'm always on the hunt for that. And opportunity is never obvious. It's a lot easier to avoid pitfalls of investing. Way easier. Just don't do things that are dumb is probably rule number 1. But then what do you affirmatively do? You look for things like this. You look for companies and sectors that are deeply discounted because the market is pricing in something that may not be true. And I have been, spent a couple of my live streams talking about this. And the better part of my week has lamentably not been trading. There's not been much to do. I mean, when you have a chart like this, with 0 pullbacks. It's just green bars all freaking week. I mean, there's not much to do except be in the market already. But so where's my there's nothing. I had to take the position about a month ago, I suppose, in IBM and CrowdStrike. I may have missed. I have a small but not a very big one because I tried to enter it, didn't work. But IBM bounced off of a very key 50% level. Let's bring it up to the weekly right here to show you. So I had a 50% level from the trend that started back in May. Let's clean that up a little bit. All the way up May 2023, actually. All the way up to the high of November last year, and it pulled back 50%, did a little dip down to a 50% level with the volume profile backing it. And last week it was a little dicey, but people asked about it, and you just got to hang on to it. I wish I could be a YOLO trader, doing 0-day options and things like that. But I'm the older I get more investor minded, and so finding that sector-wide meme for the year is what I search for, and this was it, or it is it. It's not. We don't know for sure, but you got to look at what's being sold off this year. I mean, you can follow the memes and the narratives, and that would of course be AI. But by the time people are talking about it, the opportunity is usually gone. We also got to talk about the chip manufacturers too, because that's one from about a year ago. So all these things that I like to do, they develop over a long period of time. Sometimes I get lucky and hit something really quick, but yeah, these things take a while to develop. But these are the ways that I like to allocate capital, and it's done well for me. So we'll look at all that kind of stuff. We do have stuff to say about MicroStrategy. I'm trying to pivot away from MicroStrategy a little bit, but I don't think I can. Um, we'll talk about it. There's a CoffeeZilla video that came pop this week, which is basically summarize my criticisms of what that business is doing. But we'll talk about it. What else do I have on the docket? This week in memes. Speaking of market memes, I don't know if you saw it come across. There's a company called Newbird, which apparently made shoes. And by pivoting this week to what is the stock? Hold on. See, what is the symbol for Newbird? By just simply pivoting and releasing something in a press release about it was just Bird, about how they're pivoting to AI. They had something like 140% pop in a single day. You guys remember? You guys have been around long enough to remember. I mean, if you don't, when companies a few years ago, is like in the 2021, the prior era, pivoted to blockchain, right? And how every company that released something about how they were pivoting to blockchain ended up going to their stocks just blew up. It's one of those things. It's one of those things where uh, it's kind. You can't call a bubble. Shorting is really hard. Don't go short AI right now. This is a meme from also this week. Somebody throwing away The Intelligent Investor by Benjamin Graham. In case you don't catch the meme, Warren Buffett, the GOAT of long-term investing, he's often cited that he was inspired entirely by Benjamin Graham's work in determining the proper valuation of stocks and how he built Berkshire Hathaway. Berkshire Hathaway also, as a matter of fact, I picked up in my tax advantage accounts a couple of weeks ago. How's that doing? I tend to make it a point not to check tax advantage accounts because they're long-term. Oh, okay. Well, it's holding where I got into it basically. So we'll continue not checking it. All right. Let's see what else this week. Oh, this is big news for a lot of people. The SEC is doing away with pattern day trader rule. Sorry about that. I'm opening this. This is a good example of just because you can doesn't mean you should. Yeah, we'll look at all these PFE and stuff. Hey, thank you. I just went for some exercise and showered. I wanted to smell good for you guys. So pattern day trader is something that has been really stymieing traders for a long time. The whole idea of pattern day trader rule is if you have an account in the United States, like it's equity is a margin account. I think in cash accounts it doesn't apply. I don't know. Either way, it's going away. You were not able to take 3 in and out trades in the same product within a 5-day period. What that means is if you were to buy Tesla on Monday and then sell it, I think it was the same day, that counts as 1 day trade. And then the next day, if you were to buy Amazon and sell it in the same day, that would count as 2. Now, if you held it just overnight, this would not apply to you. But where this this obviously would aggravate people, because what would happen is if you violated that rule, your account would be stopped trading. You'd have to contact customer service and say, I'm sorry, I won't do it again. And they would reinstate you. And then I don't know how many times that would go on. It affected me years ago when I first started. Fortunate that I can fund an account where that isn't a problem now. But a lot of people get starting out, they can't do that. And my criticism of that would be that people who are just starting out with trading, you need to be able to stop out of a bad trade and not have this extra regulatory burden of considering, oh, I can't exit this trade because then it's going to count towards one of my day trades this week. And so it kept people from on the positive side, or the negative of the positive side of being able to take the trades this way, it kept people from learning. On the flip side, it keeps people from over trading and blowing up their account by requiring $25,000. It's essentially you need to have some money so that you can afford to lose it. I think that's the gist, the spirit of it. But at the end of the day, I believe if it's people's money, they should do it. In fact, I would rather someone with a $5,000 account blow it than somebody with a $25,000 account blow it. And so, because then the price for tuition and not blowing your account is objectively lower. It's just math. So that has been lifted finally. So it's sort of it's a good thing, and it's hard to say if it's a net good thing or not, because I think it was preventing smaller traders from. I'm going to say this is a net good thing. Let's just let people have their own, be responsible for their own money. You got to be 18 to sign up. You're an adult. You had to get that money somewhere. You either worked for it, somebody gave it to you, whatever. And if you lose it, that's going to make a mark. And I hope you don't do it again. So that's actually pretty big. That was keeping people from taking a lot of trades for better or for worse. So yeah. All right, what's up in the chat? I was told Microsoft is dead because Copilot bad and Claude good. Everything every year people get in this like mindset of something's bad going on. Okay, guys, I've been doing this for many, many years, and well over a decade. And when you look at charts every day, and this was before Twitter was used for financial information. When I first started in 2013, like professionally trading and investing, Twitter was still just, I took a dump. It wasn't our information highway, essentially, as it is now. But in the news, CNBC or how did I get my information back then? Well, a Zero Hedge was how I mostly got my information. Yeah, 10 years ago. And after a while, I learned the Zero Hedge was to a non-zero amount, a significant amount, hedge fund propaganda to try to influence market behavior, because they would talk about, oh, you got to do this, you got to do that, or this is going down. It's just people talking their book is what I read that as. And I heard it every day that there was, back then it was the next 2008. You don't hear about that anymore because we've got COVID that's kind of in between, and the recency bias, that the human sentiment has kind of worn off, so you can't really use that anymore. You could, but most people just don't, because that was math 17. What is that? 18 years ago? Wow. I wasn't even. I was just working a job. I was happy to get my bonus and buy a motorcycle. That's what I did back then. But after that, once I saw how impactful the financial market was to everything, that's when I started to get interested in it. But I did not actually trade through it. And so, lingering in my mind more so, or the same so, or a different so than others, is the actual, I'll call it fear, that what we saw in 2022 and what we saw in 2020 are very minor in comparison to what we experienced, we as a people, in 2008 and into the early 2000s. These are, and this is on a weekly time frame, like that's 160 weeks. That's almost 3 years. Yeah, not quite, but yeah. And then the other one was in fact 99 weeks. Of course, if you count how long it took to recover, it's many years, many, many years, many, many years. So it's coming. I mean, it really is. I mean, we don't know when, and everyone is sort of like, oh, it's happening because this reason. But these required some kinds of structural collapse. And there were a lot of arguments that, oh, well, the oil going up is going to cause a structural collapse. Or sometimes when people talk about, yields, the 10-year yield is going over 4.5%. How's that doing, by the way? Yields. I was told by experts that 4.5% meant that the United States was not going to be able to refinance its debt, and finally, the dollar is going to fail. But it's happened before. It's hanging out there. Obviously, people do know that it's the line in the sand. So I don't sell fear. I make it a point not to sell fear. Hold on, where is that? Where's that thing from a couple of weeks ago? There was, oh yeah, I bookmarked them. Hang on. I talked to friends. I think I showed on here. No, that's not that. Where was that? I had those saved. I closed them. Most put volume. So a couple of weeks ago, yeah, so 0 to 7 put calls, the loudest, all in. Okay, that's bullish now. But there was most speculative traders panning. No, where is it? Let's see, record put buying. This was probably back in March. Oh, here we go. So retail investors basically before the market bounce were incredibly bearish. In fact, I think that the other metric that I talked about with friends, what's up, Cecilia? Yeah, so this is March. Investors are getting very worried about the downside risk of their portfolios. VIX call volume buying and S&P put buying is at near record high levels. And so the question I asked rhetorically then was, when everyone was bearish, when everyone is convinced that something is going to happen, does that actually happen? I always just default to the answer no. Let's go, hold on. So March the 7th. They won for a little while as things started. Yeah, so that was on the weekend there before that Monday spike. I think that spike was some kind of potential resolution. I don't know. The news comes in so fast. But at this point, everyone was to the downside. And that's the thing that you run into when you trade and you understand is you can be right in the immediate term, but did you take profit? And so that would be the question. And the answer is probably no for a lot of people, because when the fear and the sentiment builds up, that's when people, they especially when you have a little bit of profit in your position, you do not want to give it up and you want more. And so do you think people took profit on their puts at the bottom? Well, I'm going to tell you no, because when you have something like this, it's people that's a short squeeze. That's people being forced to unwind their bearish positions. What's funny is that, as far as I know, nothing's changed in the Iran stuff. And I very much lament certain individuals with orange colored skin messing with the purity of my market price discovery, because it was happening with the tweets, the Friday evening truths and things like that. I don't like that. I don't like that at all. I would prefer market discovery just happen organically. But it's the market for this year, last year. And actually, I'm a little salty because I remember there was a Truth Social post right here at the bottom back last year where he explicitly said, now is the time to buy. And I didn't get that this year. Nobody posted. He didn't post buy now. Dude, bro, where's your, tell me the bottom. If you're gonna manipulate it, tell me the bottom. Hashtag no politics. Anyway, could the collapse be upward this time? Well, that's what I'm saying, basically. So, in this structure right here, the collapse is upward. This is what you call a melt up. When everyone was positioned to the downside and suddenly the downside is not happening and now they have to unwind. Not to mention anyone that was bearish who is now in a negative position bearish, they're not going to add to a loser. So you don't have people shorting, you have people closing their short positions, and the market just yeets. So the thing about money printing, I had a conversation about this with some friends. I have a little friend group. We talk about these kind of things, and uh, the number in terms of debt is not something that we can really fathom. Okay, it's big, it's scary. We know it's not good, but bear moving with this thought experiment a little bit. So, I imagine a doctor, okay, or any high earning individual. And people go to him, he fixes their body, they pay him, and then he goes out because, he wants to, look good and everything. He buys a Ferrari, okay? So he goes to the dealership and he says, like, "Give me a Ferrari." And it's like, "You're a doctor," and he pays for it and he drives off with the Ferrari, okay? And what he does that with is money. And what if we didn't have that layer? Like, what if people just went to him as a doctor and he fixed them, they didn't pay, and then when he goes to get a Ferrari, the dealership is like, "You're a doctor, you're a cool guy, you help a lot of people, here's your Ferrari." Philosophically, there's nothing to stop people from just giving somebody something. It's just that we trade it for this medium exchange of money. And so the idea is that you're transferring value to one another. And the way we do it, the transaction layer is money. So money matters, it does, but it's still just an abstraction. It's just a way of measuring value. And where things get into trouble, really, like practically with inflation, is when that measurement is something that's not consistent. Because we are human, we have psychological biases, and we have recency bias. Like you got people that are older who's like, "Well, I used to get a pack of baseball cards for 10 cents that I worked all summer to save up for." Or, cheeseburger. We memes from like the 90s of, advertisements from the 90s of when you buy like a whole Denny's buffet meal for like $2.99 or $3.99. And so we have that in our minds, like, "Oh, that's what prices should cost." And that'd be cool, but let me veer into such a dirty word in my libertarian circles, Austrian economics a little bit. No, excuse me, the opposite, Keynesianism. Okay, oof, bad, dirty word. Um, the fact that money is inflationary, it, I don't know if it's necessarily bad. It happens. It's just the problem is when it gets out of hand. And then we think it's bad because we want to just have a dollar. I don't have it. Do I have a dollar here? Yeah, I have a dollar. Actually, this is actually a pretty good example, as a matter of fact. No, that's not a good example. Hang on. Here we go. Here we go. This is an example. So this is a new $100 bill. And then this is a $100 bill that you probably just haven't seen in about 40 years. And so, but both of them are worth the same amount. But it is objectively wrong for me to have held on to this piece of paper for 40 years. I found this when I was going through my childhood home, actually. I kept it just as kind of a reminder. But it's cool. It's cool to look at this thing. But this is wrong per inflation. This would have bought a lot of stuff in the 1980s. Yeah, this is actually, speaking of, being born in the 1980s, now that I'm becoming a boomer, I sigh audibly. Okay, I'm sorry. This is 1990. So this is only 36 years old, not 40 years old. Yeah. Wait, no, yeah. 36 years old. So anyway, 36-year-old $100 bill. One should not have this. One should have spent this already. It's a wrong decision. But we would love to be able to have this $100 stay the same value for 36 years. We would. I mean, we would love that. But at any point in nature, do you not deal with one of the fundamental realities of entropy? Energy has to flow through a system. It's constantly going from one state to another, a more organized state to another. You have to have that velocity of money. It's what the interpretation. And so there's nothing that you can sit. Here's another example. I was doing some yard work, and I know this is not really trading. This is philosophy. We're going to get to symbols in a second, but just let me finish out this. But I was doing yard work the other day, and I had this old shovel. I was digging to plant some fruit trees, and I left it out, and I left the house, and I came back, and I'm using it. I feel it in my hands, and it's got holes in it. And I look, I was like, who drilled holes in my shovel? And I realized carpenter bees had drilled holes into it. I left it outside, and some organism had decided to engage in a little bit of entropy. I would have loved for that shovel to just sit there and be in the same state that I had left it forever, but it's wood and nature wanted to reclaim it. So the idea that we should have like a thing that sits and is always the same value, it'd be nice, but I mean, I don't want to say it's not realistic, but it's just not within the rules of the universe. I know this is kind of like some thing, but this is thought experiment, okay? And so the rate of change of prices is to me is more of kind of an annoyance, okay? But it compels people to go out and produce value and energy. It also compels people to be forced to invest in the stock market and take risk, where people would prefer not to do it. But I'm not convinced that it's necessarily a bad thing. I'm not convinced, especially that inflation, whatever it is right now, or even the money printing, is this categorically absolute bad, destructive, going to end the world thing. So what I try to do is find ways to allocate that capital where the energy is flowing. But then also you want to stay in things. So you do want to have entropy work in your favor. You want energy, money, capital to flow into the thing that you bought before. Instead of holding on to a 36-year-old $100 bill. So that's my framework for approaching that. And it's why I'm a little less sympathetic every time it comes up for the world is going to end because reason. And that reason being, the national debt. And I could be wrong. And I am living my life wrong, and I should be hoarding gold. And, well, I am. I actually bought a house to grow some food and stuff like that. So at least I'm doing that. And I got guns and ammo. So those are pretty inflation proof, actually. Those are very useful in the case of, societal economic collapse, I believe. So I'm good. I'm good either way. But the message I'm really trying to kind of say is, don't worry, man or woman. It's all right. It's going to be, it's more than likely not. And this was the message I was trying to impress upon some of my more, friends when this was happening here a month ago, and then this was happening here a year ago, or as I would tell them when things were happening back in 2022 or even COVID, things are probably going to be okay, because we all kind of have a interest in things being okay. Like we kind of want this whole experiment of the market, society, the economy to continue working. And I think that when it faces shocks and challenges, rather than just assuming that people are going to throw up their hands and just be like, "Oh, we're screwed. All right, time to go back to sticks and rocks and fire." I think that we're going to fight to keep what we have, like anyone would. So I think that the American economy, I think the world economy, even barring nuclear war, which I was assured was likely going to happen. I think barring that, we're going to be okay. And I think that is the default that anyone that is trading and investing should always presume. Things are probably, I mean that in the literal term, probable, like the highest probability, like 95% of the time, if not 98. I don't want to say 99. 98% of the time, things are going to be okay. And then when they're not, a couple years later, you look back and you're like, oh, okay, that was a buying opportunity. So that's my RAM. That's my TED talk. Thank you for hanging out for it. All right. I want to talk to Zygor about it, but we'll talk later about that. So, let's see. Every single place in the world prior to 1694, we had that. The value of money appreciated in many cases, especially in economic centers of power, is absolutely false. It's not within the rules of the universe. Oh, okay. I think I need to have a debate with Zygor about this, but anyway, we'll continue on. All right, folks. Let's see. Inflation always gets out of control. That is the problem. Exponentially so until collapse. It's the mathematics of debt created currency model e to the x. We'll see. I'm not saying that you're wrong at all. I'm not saying that you're wrong. I am being contrarian to the contrarians. And because a lot of people fancy themselves as identifying that the current status quo is unsustainable. Like most people, they get up, they go to work, they get a job, they get a paycheck, they buy their food, buy a house, etc. They just go about their life. They don't think about these things. And people spend a lot of time thinking about, like what all this stuff going away, and I need to prepare against, I need to hedge against it. And there's plenty of people out there that sell these products and stuff like that. Oh, that sounds like a good segue, actually. So this week, CoffeeZilla, who, if you don't know his channel, he does financial scam channels, or rather, excuse me, he tries to expose financial scams. And so let's see, let me get to theater now. There we go. Well, let's just listen. So this is about STRC. This is about MicroStrategy. MicroStrategy, as you guys may have looked at the chart, it popped up. Let's first look at MicroStrategy this week. I don't want to be a MicroStrategy analyst, but there's a lot. Actually, I got a lot of stuff on the list to talk about. Okay. So MicroStrategy, I was doing some things today. As you guys know, I was long from about 123 and I cut it about 129 and oops, missed out. But you know what? I wasn't gonna let this thing go negative. So I have no regrets. Hashtag no regrets. But if we do a volume profile on everything back to 2024, what you see is that it is now sitting at a resistance closed above it for the week. This is daily. Yeah. So we got to kind of wait and see. There's your potential breakout, actually. And if I analyze it from the perspective of Ichimoku on the daily, it's almost about to break out to the upside. So you're actually possibly going to get that yeet. You're probably going to get that see I told you so. That's what you need to look for. Look for the see I told you so of social media. People celebrating and bragging about how smart they were to not sell their bags and stuff like that. Watch for that, because within the anatomy of a bubble, this is following the exact pattern. You're going to have some sort of, I don't like to call it a dead cat bounce. I think that's too broad, but you're going to have a post bubble blow off yeet, which you don't know where it's going to top out. You don't know when it's going to happen, but that is either going to be your final opportunity to get out, or in fact, most of the time it's going to be your final opportunity to get out. But you know what? Who knows? Let's just say it's poised for a breakout. Objectively, technically speaking, MicroStrategy is poised for a breakout. But these are some of the points that I've raised over the last couple of weeks that I kind of want to share from this guy CoffeeZilla. So let's listen real quick.
I'm not just using that word financial engineering as some sort of, gotcha. Like that's how Michael Saylor describes his own product.
Stretch is the simplest instrument we've ever created from the point of view of the investor, but it's the most ambitious piece of financial engineering from the point of view of the issuer.
And I think this is at the heart of the mismatch. When most people hear about Stretch, their friends tell them about it. Michael Saylor is talking about it all the
time. I agree with his criticism here, which he's going to get to, which is it is a piece of financial engineering. And that's not inherently bad, but where we really get into the issue of it is this.
Stretch is the simplest instrument we've ever created. Here's what I realize, right? The world doesn't want you to write 10,000 pages of history to explain what's going on. They don't have time to read. The world just wants the answer. What do I want? I want to put my money in a bank. I want them to pay me 10%. I don't want the government to tax it. Okay, how long was that conversation? That was like 12 seconds?
Mm-hmm. Right, so key to strategy.
Yeah, and this kind of goes back to our talk just a minute ago about money and having things go up in value for than just existing.
Is its simplicity, according to Michael Saylor. That's what the world wants, and specifically, he's pitching to retail investors. He's pitching to everyday investors. He says most of the buyers are everyday people.
In fact, 80% of Stretch is held by retail investors.
The issue is, and actually,
it's meant to be a retail product that's really easily accessible by
mom and pop who ultimately that's why they're
for them. You live paycheck to paycheck. They're
income investors.
But what about people who are watching who maybe live paycheck to paycheck? They're lower income. Is this a product that would make sense for them?
Yeah, this is another sort of aspect of this product that excites me, and I know having written Bitcoin for everyone, right? Like I'd like to say stretches for everyone. And I know this is important to you, is a product that is for people across all income levels.
But is it really for everyone? I mean, if you just have a rainy day fund, should you?
And that kind of goes to my issue with it. I'm in my little small world of being a financial commentator, constantly people are impersonating me. They put my little blue troll doll, although I challenge them to actually show that they actually own one when they're trying to impersonate me, and try to get people's money. And I just hate that. I mean, I hate scamming old people, telling them that they're the IRS or the government's coming after them. We're gonna go into a whole new realm of fraud when it comes to AI imitating people's voices, but make sure that you let your parents know about that. But it just rubs me really the wrong way. And the problem that I have is in the pitch. The pitch being that it has the lowest volatility of any product that's out there, that it is like a bank, it is like a money market. In different interviews, they just kind of said that. And here's the thing. I don't think anyone's that dumb, but I don't think it's going to fail right now. In fact, mathematically, they have enough money to pay this dividend for about 2 years. Okay. And so they're betting, okay, Bitcoin is going to recover and things will be fine. You know what? I think it's actually going to work for the next 2 years. But with this kind of advertising, using this advertisement right here.
Some of these weren't meant to live.
These kind of
I'm retired.
Using these AI generated ads. When do you ever know like VOO or SPY or an index ETF to ever need to create AI advertisements
Stretch is a stock.
Present
right now I get about
this kind of thing, like,
a year in
you
dividends.
can just have your money in this thing, and read the thing right. Read this fine print. I mean, that's their kind of their disclaimer. But then they have those interviews where they say like, oh, people want to put their money in a bank. well, we do that. Or, this is for everyone. We 80% of the people are retail investors. And on the other hand, they say, oh, we've got lots of institutional investors. It's not a consistent, totally honest pitch, because I don't think that that's their priority. Their priority is to pump the price of Bitcoin. And as long as they're operating this, no one's calling them out. No one is calling them out and saying, you guys are being scammy. The SEC, back when I started several years ago, back in my boomer times, my mentor, who also did financial commentary, he gave me a whole long disclaimer, which I put at the bottom. I took a version of that and put it at the bottom of every video that I make, because years ago, everyone was afraid of like the SEC goons, coming up to your house and barging in and arresting you for telling people something about something being no risk and going to make money, ostensibly to protect us from scammers. But that's kind of gone by the wayside. They don't do that anymore. And so we've kind of transitioned into this, especially with social media. They just can't enforce it all. What happens is major high profile cases of fraud happen, or people have to get together and do a class action lawsuit against a company for selling a product after it goes bad. And so as long as things aren't going bad, people are content to not, blow the whistle. But this goes back to my, contrarian nature. The fact that people are releasing videos being critical of it now tells me it's probably going to work for a while, really, because again, the sentiment is not entirely bullish on it. In fact, in Bitcoin circles where they hope that it's going to pump their bag, they're very bullish about it. But now more and more commentators are criticizing it. You'll see more criticism on Twitter, and I'm telling you guys, what you need to watch for is you need to watch your Twitter algo. You need to watch your feed for this thing, which could be coming right now, where everyone begins to celebrate and dunk on the haters. Watch for that. Watch for people to be going around and like just proud of how smart they were and how they were just the kings now, and everyone else is left behind. Ha ha ha, you should have bought like I did or held on to it. Have fun being poor, losers. Watch for that. That's going to be the euphoria for this little pump up that could be about to play out. So watch for that. And those people don't get to win. They don't actually get to win. Don't make that mistake. But it could happen now. It could happen in the next few years. But invariably, this scammy behavior is going to eventually catch up to them, because it's not that what they're doing right now is going to fail. It's that they have a habit of this kind of scammy marketing. They have this habit of buying price indifferently, being horrible traders. All of their preferred stocks are now trading below par except for STRC. In other words, everyone that invested in every prior product is below par. That means if STRC starts to go below 100, they're just going to release another one. They can't stop. And what happens when you have an addict? What happens when you have an addict? They can't stop. They eventually either end up in jail or broke, or both. So enough of that. You can't hear me when videos are in the background? Okay. I wonder why they did that. It must be the thing. Okay. All right. Let's go through a round of yeah. Yes, I bought Truist back in the .com, or not .com, the bank's going to fail moment. All right. Let's get your symbols in. Let's go through them. Oh, you asked about what is it? The comeback kid asked about Intel. Yes. Intel is another one of those where I picked it up back in 2024 and had to sit here watching this thing for a whole year until it finally mooned. So again, going back to what I said at the very beginning, Sometimes the things I do take a while to play out, but Intel, yes. Now, that being said, a couple of interesting things to note about Intel. Let's take off this right here and go to a monthly, because now our monthly, you need to watch to see these highs and make sure that you get a close above it. I don't think that this is a false breakout yet. Give it a second. It's not really enough of a push above it. I want to check on AMD because this is all related. These are all related. AMD, that is another chip manufacturer that does have this week, was watching it, a confirmed breakout. I wanted to pick this thing up at 172 and it didn't get to my level. RIP. But this is a confirmed breakout of AMD. So when I'm looking at Intel, I'm looking at AMD. Another one to look at is Micron, which has been going crazy. This had a false breakout. I got it circled here, which I had a buddy of mine was in it, but that is a pretty quick recovery. And now you're back up at the level. So right now, chip manufacturers, including Intel, which I'm in, been in for a while, are at they're testing their all-time highs. They're testing this level. And what an interesting time. I don't have an answer for you this week. Right now, though, you just assume that it's going to keep going. But there's nothing glaringly wrong. There's nothing bearish about it. Let's put it that way. I'm not sitting here. No, this is not bearish. You wait and see until you see something that's a little more convincing of the trend ending. But as far as I see, basically price got pulled up to the resistance level, and that is where it now sits at the close of the week for Intel, AMD, and Micron. So hodl your chip manufacturers from now. So we looked at Mara. So Mara is okay. Mara popped up this week, due in part to this. I've talked to this guy, Peter, met him a few times. He's a cool, really smart guy, really deep in the weeds of Bitcoin development. And he's pointing out, which I think I mentioned like last week in passing, and we'll talk a little more about how Bitcoin mining companies are starting to completely switch. In fact, let's see, what is it? It's not just a few. It's where is it? Almost 100% of the so the point is, we've never seen a scenario where 100% of the Bitcoin miners are unanimously and voluntarily pivoting away from Bitcoin and telling the market they expect the majority of their revenue to be from something else in the future. So the entire Bitcoin public mining community, like the big corporate, largely capitalized, are not investing in more Bitcoin mining. They're pivoting to AI, frankly, because there's a lot more revenue potential. For those that aren't, always in the weeds about Bitcoin rewards its miners with Bitcoin for doing the work of securing the network, doing the processing. But over the last year or so, because of, correlation causation, but very causative, the actual on-chain transactions, actually using Bitcoin for transactions, has dropped to record lows, like throughout its entire existence. Like what they say about the mempool, in other words, the backlog of transactions that need to be processed, and many times have been empty over the last year. Haven't looked at it recently, but I had a buddy that worked at Marathon, and he was let go because he and other people were working on methods to try to generate revenue within the Bitcoin ecosystem as miners. And he developed some pretty cool tools like layer 2 solutions, was also working on quantum resistance, and he's out of a job. These companies are going the other way. And that isn't death to Bitcoin, because the anti-fragility built into Bitcoin essentially means that the less miners there are, the lower the difficulty is. In other words, the fewer miners there are, the more money each of them makes. So it sort of evens out. In other words, smaller miners, you're going to have more profitability, more likely to stay in business. But the overall effect is you have less energy, less processing going into securing the network. which makes Bitcoin more vulnerable to a potential 51% attack. In other words, where you produce enough processing power to take over the network, reprogram the Bitcoin code if you want to, or reverse transactions. In a really bad case, you could even start creating more Bitcoin if you completely change the code, if you control 51% of the network. I'm not saying that's going to happen, but by having less participants mining, that threat goes from negligible to not negligible. And that's what's happening now in the space. And so we're going to, just like I was saying earlier about that bird converting to AI, do I think that these companies that are pivoting to AI are going to necessarily be a buy? Maybe, but I'm starting to see some frothiness. However, I've talked about this before, Amara's law, where we underestimate the impact of, or excuse me, we overestimate the impact of technology in the short run, and we underestimate it in the long run. Probably what I would say is going to happen is you're going to hit some kind of thing with AI, and then people are going to be like, oh, wait, we put too much money into this. You're going to have a crash. You're going to see a lot of these models, these companies like OpenAI, Anthropic, at least one of them is either going to be forced to merge with the other or go out of business, or something's going to happen. And then you're going to have this consolidation. Everyone's going to say, oh, well, that AI wasn't all that big, blah, blah, blah. Then you can start picking it up, because then that will be the actual point where you can have actual sustained, useful growth. Or you could be like me and you could be spending hours a day working in AI and throwing money at the companies to give you the token power. Problem is now they're burning so much money right now, subsidizing everyone's tokens. But that's not a problem for tech companies. They've been doing it for 20 years. Amazon didn't make money until like the mid-teens, and their stock just kept on going up. So what an interesting time. What an interesting time. All right, so the other things to look at, PFG. Principal Financial Group, that's making a run for the high. That's bullish. PFE, sorry. I think, yeah, we talked about this on Discord here. This is doing a potential weekly breakout. This is good. This is good for potential weekly breakout. Let me revise the target on something like this. Let me do some analysis here. So if one were to start getting into this long, not much help up there, but you've cleared the volume profile of it. This is a really good long. It is actually. It is legitimately. I like it. I like it. Good stuff. I like stuff like this. I like stuff that is 56% off of its high. I like that kind of stuff. That's good stuff. I do not like stuff that's going up, unless I'm in it. I love it, but it's hard for you. Monero has just been going through a nice, steady, slow appreciation. Sometimes it beats Bitcoin, sometimes it doesn't. But I think you'll be hard pressed outside of Bitcoin to find something that has been as stable and resilient. I mean, you can find some other coins, but my thesis on Monero is it remains unchanged. What you do is you expect slow and steady adoption and appreciation, segmented by the occasional massive 300% yeet. And you need to be in the market to catch that yeet. And that yeet could happen at any point when people go to transfer Bitcoin and make it anonymous. So that thesis remains in place. Not giving me any reason to worry about it. Let's see. CAG. I cut CAG. CAG this week. On Monday, they announced they're firing their CEO. It sucks, but it broke below the level, so I can't stand losses. I cut that position. I only want things that go up. We talked about CrowdStrike. CrowdStrike is just like IBM. It is my one of two picks for software as a service is overblown. Excuse me, SaaS is dead, is overblown, is CrowdStrike and IBM. So bullish, holding the 50%, roughly, holding the volume profile, definitely. Thumbs up. All right. So UNH, that is another volume profile level that we check in every week, and got a little dicey here the last couple of weeks, but pulled back up. Let's just hodl it. I mean, if we want to know what can happen, look at Intel. Not saying this is going to happen, but whenever something, as long as something doesn't do like ConAgra did, CAG, where it just drops into a situation where it's like, okay, this is more risk than I want to take on. Let's not bag hold. I'm content. So I'm like I said, the last check-ins, as long as we don't go below 245, I'm going to hold on to this thing for sure. All right. So, and HIMS, keep on bringing that up right here. HIMS, hey, it's working. It's just not like a chart that when I read this, I really see anything that is particularly, I can't really trade that. I think that 16, 17, if you really had a bullish bias, would have been really good. So that would have been my line of sand, and you're doing pretty good from that. It was hard to determine what level here, but you can kind of see structure here at 2160 and then down at 1617. Either way, nebulous volume profile holds. It's good. It's bullish. Hold on to that. Intel, we talked about. GIS, that's probably going to be related to ConAgra. Oh, gross. Okay, well, let's see where's. Yeah, so I had marked this off. Let's go up to a monthly. Oof. I think though that basically ConAgra and GIS are basically the same sector. They're both, I think, agricultural food products, right? Yeah, basically. So it's already broken below 38.42. What is the next level? The next level is 29.48. I know that sounds pretty deadly, but I'm going to add an alert there. So yeah, that's the next level. Save that. MOH. Is that Molina Healthcare? Yeah, we'll assume it's Molina Healthcare. Obviously, I've marked this up from prior ones. Maybe you've asked before. 134.96. I like it. That's a really good level. Hodl that one. Don't let it go below the level though. So these are good. These are good. TLT. I'm holding it. Waiting. I got to the end of the year. I got to the end of the year to get this thing over 91. It's bonds. What do you expect? AMD, we talked about. AMD looks like it's doing a breakout. Yeah. So okay. I think it captured. Okay, CPB. So just because a dividend is really high doesn't mean it's necessarily a buy. Because one of the reasons that you're paying so much, I mean, just go back to the stretch example. Why are they paying people 11.5? What they don't say this is because you're taking on risk. You're actually taking on a lot of risk that this company is going to like not pay you back. But in the case of any stock, when you start getting like in this environment right now, the risk-free rate is like 3.5%. That's, you put your money into a savings account, you do nothing, you take no risk, and you get 3.5%. So what you're asking is, what is in excess of 3.5%? What are you getting? And so 7.4 isn't in that get away from me, this is probably really risky, but it's definitely risky. And the problem you run into with dividends, stocks like this, is they're paying you a dividend for a reason. Is to get you to try to hold the stock, because if they start cutting the dividend, it's going to hurt the stock even more. But I've not actually found that going for high dividends it's such a double-edged sword, because one of the reasons you're getting such a high dividend yield, which is based upon the share price, is because they paid the same dividend, but the share price is going down. And if the share price is going down, that means that there's something that's a little broken, and the market is valuing it as broken. The market can be wrong, but the reason the stock's going down is implied that this company is not going to be able to pay that dividend, or they're going to cut the dividend. Like we were in WHR a while ago, and they cut the dividends. I exited that position, and this is why I got out of ConAgra, because I got into Whirlpool it's been a year now? Maybe it has been. Last year, and it started dipping here in November. And so I closed it out just like I did with ConAgra because it just wasn't working out. And it did recover a little bit, but but now this is the first time I'm checking it since I got out in November. This is why I got out of it, because even though they were paying, or originally they were paying like something like an 8% dividend yield. So it was 175. When did they cut that? Yeah. So originally they were paying $1.75 per quarter, and then they cut dividends to 90 cents to get them more profitable. And that didn't necessarily tank the stock, but now you see. So a high dividend is the double-edged sword of risk and reward. You're getting that high dividend because you are being incentivized to invest in a company that's kind of hurting a little bit. If you're a solid company like Coca-Cola, Coca-Cola can get away with paying a little dividend because it's Coca-Cola. You know, they can, here, have a little bit of money to hold our stock. We don't need to offer you a bunch of money because we are who we are. And so that's why you're not going to get paid good dividends from a company that's in tip-top shape, because basically what will happen, what is the dividend of Coca-Cola? That's just kind of like the benchmark, you know, solid stock could change, but so Coca-Cola, 2.74%. So it's less than the risk-free rate. So they don't even have to give you what you would get in a savings account, because they are considered by the market to be solid. There's no risk premium there. And what happens is, because everyone in the market assumes this is good, they arbitrage the price up such that the dividend yield, in other words, it's based upon the share price versus how much they pay you every quarter, is very, very low. Because if it was higher, that means that the stock price was down. But this in the case, you know, if Coca-Cola stock price came down to, I don't know, like 60 or 50, then you'd have a dividend yield perhaps that's closer to you know, these higher dividends shares, because it'd be basically what you get paid divided, the share price divided by the dividend every year, and that's what you would get from the yield. So just because something has a high dividend doesn't make me automatically interested. And actually, WHR is one of those examples where I hate taking losses, but I did, and by doing so and having my capital doing something else, whoa, okay, it's hard. It's kind of hard to see this in a. So I probably close it out here in the week of November when it dipped down here. You know, either definitely not there, probably here, but I still have 16% more money, more capital, having done that, made that decision, than I would have back holding. And I think they dropped their dividend to maybe, I think it was maybe like I don't know let's see what it is. I'm quite sure that it's not going to make up for it. Yeah, so actually Whirlpool, it was 8% when I got it, and I think they dropped it down to like 6%. And so now, because the share price has gone down so much, it's back up to 8%. But I lost in the span of just less than 6 months, 16%. So the dividend, I would have maybe gotten, you know, 3-4% from it. Math is not in my favor. I've lost money on this if I would have just held on to it for the dividend. So yeah, high dividend is actually, you can look at it as opportunity, but you also have to look at it as risk. And it actually is a sign of an unhealthy company to offer such a high dividend. So would you ever have an open chat on Discord to discuss questions live? Absolutely. In fact, click on the link below. I have a link to my Discord. Come hang out. I mean, I answer questions all the time when people have them. But yeah, yeah, come up with it. After I've talked for an hour here, I don't feel like doing it today, but hit me up. Actually, I love talking to people. I do. Yeah. INPP. Hey, what's up, Single? All right. Imperial Petroleum. Is this what we're looking at? I don't like that it failed to come up and try the retest and it got stopped by the 50%. That looks bearish to me on this one. ExxonMobil is my energy company. Yeah, they have a pullback. I mean, because basically, turns out I don't know what the situation is. As far as I know, the Strait of Hormuz is still closed. And but still, rumors of oil going to 120 or 200, as people were insisting was going to happen, turned out not to happen. And basically now, to kind of clean this up a little bit, this big run up, this is deadly. This is just a price action education for you guys. You come up and you make a high, and then you come up and you fail that high, bad. Same thing I've talked about with gold and silver. Bad. Gold, definitely bad. Anything can happen, but you kill your trend momentum. It's deadly because, I mean, everyone was hoping. They had hopes and dreams. And now the hopes and dreams fade. And then you're going to get some action. You're going to get some consolidation. You won't get a straight down reversal because there's going to be a lot of people still holding on to it. But you're probably not getting that high now. And so a lot of, I think the money to be made in oil, watch me say this and not be the case, has already transpired, at least the easy money. And now, I would look for a pullback on ExxonMobil to 137.10. I know that's not what you asked for, but I'm not really familiar with the IMPP. I just kind of gravitate towards the blue chips. What's the dividend yield on them? $2.71. Because the price has gone up so much. See, the price is not still very elevated, so they don't have to offer a big dividend for it. Even though they do pay a dividend, still very, very high, even with all this move up. So, all right, TPB, last one. Turning Point Brands. Is this in the vein of kind of like retail brand space? Let's see. Companies like Nike and Lululemon, maybe a lot of brands are really kind of hurting. A lot of consumer brands. I'm not sure if that's what this is. You're right. It's a little not clear. That's my only criticism of it. This big dump here. But you could probably get a nice little small risk-adjusted position if it gives you one more test of it. Because then that's going to be, you're also going to be pulled together a local 50% out of that as well. So that's what I'll look for. So yeah. All right. Thanks for hanging out, guys. Pleasure to be there. Hope you made your week a little bit better. And I should be able to hang out with you guys next week. Got some moving to do, as fun as that is. But I'm going to try to get everything set up at my new place. Wish me luck. Have a good weekend. Bye-bye.